Continuing our webinar series on institutional money management life cycle, in this session we'll deal with some widely followed metrics for analysis of companies that a portfolio manager wants to include in a fund. So broadly, there are five so-called pillars of company analysis. We'll look at each one of them and see examples of how they are used to evaluate companies and compare them among their peers. But first, let us take a quick review of what we did in the previous session. In the previous session, we introduced the broad process flow of the institutional money management life cycle. The process flow goes as follows. First is identify the benchmark, and from that get the broad universe of companies. And from the broad universe of companies, apply certain considerations to arrive at your final investable universe. That is the portfolio that you are going to manage. Then you have a company analysis. You analyze the companies which are in your portfolio, and out of that, you get a ranking scheme of attractive companies. So meaning that the top ranked companies would be the most attractive, and so on. So then you do the evaluation of each and every stock in your portfolio to see which stock is the best candidate to allocate more money. So that means that which is the most attractive in terms of valuation. That is the most undervalued stock. All things being equal, a stock which is undervalued would be that means that the intrinsic value of the stock is more than what the market is asking for. So that means that that is a sure shot buy. So you value each and every stock in the portfolio and arrive at a valuations ranking. So then once you arrive at the valuation, then you construct the portfolio. You construct the portfolio and allocate the fund corpus across the stocks in the portfolio, and then you keep managing the fund on a daily basis, and then you measure the performance of the fund with respect to the benchmark here, which we have identified as the first step. Now, we also saw that there may be some small variations and deviations of this process, but while this process, there may exist small variations. The philosophy, investing philosophy, is essentially the same, whether it's a fund in India or in the US or elsewhere in the world. So we also saw the process by which we identify the benchmarks, and from the benchmark, we arrive at this broad universe of companies. And then from the broad universe of companies, how do we filter and arrive at the final investable portfolio that we ultimately want to manage? What are those considerations? Those considerations could be market cap, liquidity, risk, sector or industry, or client specific. So now, once we do this process, now we have a portfolio consisting of the investable companies in which we would like to invest. Next is the analysis, company analysis. Now, this is also called there are five broad considerations or five broad factors which we use to analyze each and every company in the investable universe. So these are called the five pillars of company analysis. What are those pillars? First is growth, then the second is profitability, then you have financial health, then you have management, that meaning corporate governance and the strength of the management, and then you have the risks that the company is facing and how it is projected to overcome those risks or mitigate those risks. So the same metrics or parameters is used to analyze all the companies in the investable basket. Analyzing a company along the same set of standards or metrics allows us to compare apples to apples from among the universe of companies. So the data obtained from this analysis is then used in an analytical model to create a ranking of all companies in the investable universe. So thereby meaning the top ranked company in the model is the most attractive, and so on. So these parameters, let us look at one by one what these parameters are and how they are used to analyze these companies. So the first parameter is growth. Uh, and while strong earnings growth year after year feels like top of the world, only very few companies manage to achieve it. And since the information is out in the open, the company stock finds itself in great demand, and so thereby even expectations rise quickly. So the question that begets to be answered is how fast is the company growing? Is the growth story secular? That means that does the company maintain its growth even in times of adverse business cycle? Of course, when the business cycle is good, we expect that the company will do well and will have a good growth uh, trajectory. But does a company also is able to grow when times are bad? So if a company is able to do that, then it's a real good candidate to be in our portfolio. And so, how does the company plan to sustain its growth story? So, is it just a flash in the pan, or the company has enough, a good strategy and a good execution capability that it is able to sustain its growth story? So, challenge to sustained growth is that the competitors do not sit idle. So if they see that company is doing very well, they will do their level best to either mimic or to change their internal process or strategies, or even to raid this successful company for some of the people who are responsible for the success. So the pie, in effect, is shrinking, and so a company has to always be ahead of the pack. And also, one must know as an analyst, you must be very much aware, conscious of the fact that past growth is not an indication of future growth. So the company which is has been growing for the past 2 3 years, it's not necessary. It may well be a situation where past 2 3 years of growth has given the company enough capacity to grow in the future, but that is not a 100% surety. So that is something that one must be very conscious about, and one must also recognize that how has the company grown? Whether it's not just the growth numbers, but also quality of growth. And so what is the quality of growth? Whether it's a um, growth from real operations, or whether it's a one-time event that has helped the company to grow. So that's growth compared to the previous fiscal. And last but not the least, what are the sources of growth? So that is very important. So now we have to see, where is growth coming from? So one is volume. What does that mean? That means that you sell more of your products or services. And then price. So if you raise prices across the board, then definitely your revenue will increase. But there is not everybody can raise prices in a competitive market. So we'll see how and in what situations one can raise price, and thereby uh, uh, the price can contribute to growth in the company. Then you introduce new products. So when you introduce new products, and if those products find good acceptance in the market, then your revenues will grow, and so the company will grow. And then you enter new markets. Okay, so previously, a market where you are not there, you decide to enter, and you do a good job, then definitely you would grow. And then innovation. So if you have some innovative products, or if you have innovative methodology or technology that helps you to create better products cheaper, or rather to sell them in a better way, then definitely that's a contributor to growth. And then, of course, acquisitions. So if there are some areas where you don't exist, and you identify a company which can plug this hole, then you can go out and acquire the company, and it can fill that hole in your strategy. So these are some of the uh, considerations, or these are some of the strategies which help a company to grow. So now we will look at one by one. We'll look at each of these considerations. So sell more products, volume. So high quality growth by selling more products. So for example, you can have a better marketing strategy which will create new demand, or which will create enhanced demand for your products. So that will go a long way in helping you to sell more products. Then distribution. So any company which is in the FMCG, or with the consumer B2C, or even B2B segment, if you have a very good distribution strategy, then it helps you to push your products down into customer markets, no matter how far they are and no matter how small they are. So you have a fantastic reach, so that you are there when a customer wants any of your product, you are there at any time. So that is the benefit of a very good distribution strategy. And we have stalwarts. We have great companies which have great distribution strengths. Asian Paints and Pidilite, makers of Fevicol. We look at these two companies briefly and see how they have uh, very strong distribution strengths, and how their strong distribution mechanism is helping them to grow. You introduce new goods or services into the market. So these are some of the three most important aspects of, or most important strategies for volume growth. Now we look at value or price. If you take the help of price increase, there also you can get growth. So if you have a strong brand like Kingfisher or Indigo, so even if you raise prices a little, that because you have a strong brand presence and you have a strong dominance in the market, or rather your brand has a strong dominance in the market, the market is able to sort of withstand your price increase. And then captive markets or sticky markets. Now, this is the before the number portability came around in telecom. So if you are an Airtel customer, you are an Airtel customer for life. So basically, that means that that you bind the customer to yourself for all time to come. So of course, this is no longer relevant, but this is just one example. And in beer, so you see Kingfisher or Heineken or Corona. So you have very loyal customers and captive markets for you, or these are sticky markets to you, because a diehard Kingfisher beer drinker like to switch beers brands very easily, because they got used to the taste and whatever. And so there you can, if you increase the prices, people, initially they may grumble, but ultimately they will go along with the price increase. And then if you have a big moat, that meaning strong barrier to entry, and so that competitors are kept far away. So that is something. And then if you have a monopoly, and due to being the first mover in the industry, or due to some technology that is so unique, and it's so proprietary that you have a very long lead with your any of your competitor who has to sort of reinvent the wheel, and who has to come up with another technology to compete against you. So Praj Industries is one of the most famous companies which has a monopoly in the biofuel industry. We look at Praj in the next few slides. So now, again, we saw volume and then we saw value. There's always this, so to speak, competition between volume versus value growth. And so, if you want to achieve volume growth, then you may have to compromise on price. So the market is not good for you. You may have to reduce the prices because of competition or because of certain adverse market conditions. So then how do you compensate for that? You have to sell more products in order to uh, maintain the same level of growth. So that's the sort of the seesaw between volume and value growth. Okay, so now let us look at Asian Paints. The secret of high volume sales in Asian Paints is their massive distribution network. They have already 162,000 distributors, and this is as of 1 year ago. And they're adding uh, where between 6,000 to 8,000 retailers per year, and they are continuing to expand, especially in tier 3 and tier 4 markets where there is strong demand. And by the way, all this is from management discussions, whether it's in the conference call or interviews or from their annual report. And then they have a very broad product portfolio, both in the residential, decorative, and architectural segment, as well as in the industrial auto uh, original equipment market. And you see all of these is being pushed through this, 1.5 lakh distributors. And so you see the reach. No wonder they are number one in the paint segment. And so some of the numbers are bearing them out. 7% volume growth in quarter one, this recent quarter that has gone by, quarter one of FY25. 43% gross margins, and these are on a sustained level, and EBITDA margin of 20%. So you see the strength of the distribution network has a very large role to play um, in growth. So next is Pidilite, the makers of Fevicol. Their secret of high volume sales is also their massive distribution network with particular focus on urban to tier 2 and tier 3 towns and also villages with a population of 5,000 to 10,000 people. So wherever you have markets of this size, immediately they have their presence there. They have 18,000 exclusive stores. And as with Asian Paints, um, what they are also seeing is that the rural and semi-urban market is growing 1.5 times the urban market. So they have achieved a 10% volume growth in the recent quarter, which has gone by. And you may think 10% is not, just nothing great. But believe me, when you're talking of sort of lakhs in terms of products, the number of products which are being sold, 10% is a huge amount. Um, as far as EBITDA margin is concerned, so they have 24% EBITDA margin with gross margin of 54%. And see, Pidilite, Fevicol, and the associated products, the unit price is less. So they have to focus like a laser beam. They have to focus on volume sales, and so that is sort of manifested in their strategy. So they have 10 factories, and as soon as the factory hits 70 to 75% capacity utilization, they prepare for increased production. So they start their capex for new expansion immediately. So you see how Asian Paints and Pidilite, they represent companies which have very strong, which depend on volume growth. And one of the most important aspect of their volume growth is the strong distribution network. Now, Praj Industries, a different industry altogether. They are a first mover in the biofuel industry. So that means um, production of ethanol from various feedstock. And there's so what it does is it allows distilleries to convert their feedstock into ethanol, and they have a so they build plants that help distilleries to convert their feedstock into ethanol. So, and they have a 70% monopoly in the 70% sort of market share monopoly, and with something that is in the news that it is a 10,000 crore ethanol distillery capex, which is coming on stream by 2026. And so these guys have um, these distilleries as their customers. So you can see the vast market size that is open for them, uh, as far as um, in the very near future. And something else, ethanol blending is a global mandate. And the Indian government has mandated 20% ethanol blending in petrol. And you see there are lots of distilleries which are coming up. And so you see how rosy their future is. Um, One thing is that they are very intelligently they have de-risked the use of sugarcane as a feedstock. Their R&D quickly sort of took up this challenge, and so they have de-risked the feedstock problem by offering alternatives to sugarcane. That is rice bran, maize, which is corn or butta, and agricultural waste. The uh, burning of the agricultural waste in Punjab, Haryana, etc. So instead of burning, so the company R&D also uh, allowed for the pirali, as it is called, to be used as a feedstock to convert into ethanol. So using this technology, it's a proprietary technology, and they have a very strong lead against any other company. And so they have 1,000 customers in 100 plus countries across the world. They have a 10% global market share, global share of the market, and they have, as it says, they have a strong barrier to entry in technology, execution, and innovation. So that is why they are able to grow at such a good pace. So the ability to command premium price because of the number one position in the market. So that's basically, some of the examples of how companies are using either distribution or innovation and R&D, etc., good execution in order to grow on a sustained basis. The next aspect of growth is the um, aspect of selling new products. You come up with new products, and so you expand your product portfolio, and so thereby you are able to achieve growth. So one of the examples is Birla Grasim, which is a Birla company. They ventured into paints, and similar to Asian Paints, Grasim uh, basically also has a very strong distribution network, and so they are able to their thought process is that they are able to use the same distribution network to push their paints. Now the jury is out as to how successful their strategy is going to be, because it's not even, I think it's about just a year, and their goal is to sort of dethrone Asian Paints from the number one position in paints. So it remains to be seen. And so they've created a finance company which will provide finance to their distributors, to stock their paints and other products. So that's a sort of a good, interesting feature that helps both parties, the distributors and retailers, as well as the company. And then the next company is Havells. A few years ago, they announced their entry into kitchen appliances. So Havells initially started with wires, plugs, and then they ventured into tube lights and lamps and whatnot, and now uh, sort of a natural segue to their um, electrical appliances. So they they made an entry into kitchen appliances. So that's a sort of a new product segment, uh, albeit it's a very crowded segment. But they hope to use their existing brand presence in electrical products to sell their kitchen appliances. So basically, another aspect is grow the existing market by bringing in newer customers. So, for example, beer companies are now targeting younger drinkers. Beer companies also are targeting women. So women traditionally are not much known to drink beer, but recently all the beer companies they are targeting the younger women, independent women, um, the club going women to drink beer. So that's something, an interesting strategy that remains to be seen. The jury is still out. And gaming. So gaming also is traditionally a male sort of dominated sport, but now more and more girls, teenagers, and women are finding great interest, mainly because there are a lot of gaming software is now being developed for girls and for teenage girls, and so gaming companies are targeting new customers. Also, sports media they are targeting girls, football and cricket and all of these sports. They are finding increased acceptance among girls and women. So that's another strategy of growth. Then acquisitions. So you fill a gap in your offering, product offering, or you basically one of the reasonings can be that the company, the acquire the target would help the acquirer to uh, achieve a higher degree of growth. So there's a company called RateGain, which makes software. It's a SaaS software maker, which is in the travel, hospitality, and segment. And so they acquired a company called Adara. Now the RateGain makes software that helps hotels, um, airlines, rental car companies, etc. Um, have a better view of their um, potential customers. So depending on how the customer is searching, so it provides new suggestions and it tracks their actions and provides new insights to the hotels and um, airline companies. And so that is called travel intent. Now Adara makes AI products for travel intelligence, and so the thought process was that the rate gain would gain a lot by incorporating the Adara AI product into their product portfolio. So another example of acquisition is that Hindalco. Hindalco is the aluminum copper manufacturer in India. It's a Birla company, and they acquired Novelis company in US. This was a few years ago. It's an interesting company. You all know the number of or rather the the amount of uh, soda, by soda I mean Coke and Pepsi consumption in the US, and so there from there you can make a sort of a guess as to number of cans which are being thrown or which are being recycled. So what this company Novelas does is that it takes all of those aluminum cans and it recycles them and it converts them back to aluminum. It's a great company. Recently, it just went public, and so Hindalco acquired that. As far as establishing a beachhead in the U.S. So that's geographical reach. But if you look back into history and you analyze all of the acquisitions, that have happened, you would find that majority of acquisitions uh, uh, have not achieved a very significant accretion in earnings or other improvement in earnings. I would say that most of the acquisitions, while they may be successful here and there, but as a general rule, most of the acquisitions have not achieved the desired purpose because it's not an easy job to do acquisitions. There are multiple things one has to uh, consider apart from the regulation and apart from the basic technology and um, process and software and the process, but also it's a merger or of culture, and it's a merger of people. So it has to be handled extremely judiciously, and so most of the majority of acquisitions really have not been that successful as they have been hoped for. Some of the important factors that as an analyst one should ask is that it's easy to be carried away by a growth story which looks very rosy. So as they say, if it looks too good to be true, it is too good to be true. So one must ask a lot of questions. One of the questions being, is the growth coming from accounting jugglery, or is it coming from valid business reasons? And there are enough examples in the corporate graveyard, so to speak, where you have seen companies, do a lot of creative accounting, and ultimately they got caught, and they had to pay the price. So two of the examples is Satyam and this DHFL, which is Diwan Housing Finance Limited. Both of them, I would say, were led by crooks. Uh, and then another example is is the growth coming from real operational reasons or one time, for example, tax rate. Uh, I would call it tax rate calisthenics or buybacks, one time gains, or rampant cost cutting. Cost cutting is good. I'm not saying cost cutting is bad, but this uh, slash and cut. Cost cutting is definitely not good, and it's a very artificial way of pleasing the stock market, to reduce costs and thereby increasing your EPS. So that is and another question one must ask is there a steady and proportional increase between operating earnings and net earnings? So that is something that one must look at, and also our sales and earnings following a consistent pattern over the years. So let's say 5 years, is there a continual improvement in sales and thereby in earnings? One or two quarters, one may see dips, but then the general trend should be positive. So if it is positive, then we know that the company is doing the right things. Okay, so that is something that one must keep in mind. And as I said earlier, is the increase in earning due to non-operating gains, that is investment income, um, and other things. So the important metrics in growth is the some of the net sales growth percentage, that is current period net sales minus prior period net sales divided by prior period net sales. So these are quite easy, but these are some of the metrics that are used to analyze companies. So volume growth is also used. So, just like sales growth, you can also calculate volume growth, and then EBITDA growth percentage, and EBITDA margins, gross margins, and EBITDA margins, and then EPS growth. So that is something one can. And then precisely one should use diluted EPS growth, where diluted EPS is defined. It's a textbook definition, so it's nothing great. It's defined. Diluted EPS is defined as this particular formula. So till now, we looked at growth as a metric to analyze company performance. We will now look at another important metric, which is profitability. That is, how much profits is the company making compared to its own past, as well as compared to its peers in the industry. So a profitable company is a much loved company. No one can doubt that. And a sustained profitability makes it a darling of the stock markets. Now, how much profit a company is generating from the money taken from its investors, or investors meaning equity shareholders as well as debt investors. So, higher the profits, the more attractive it is to investors. And what is important as an analyst for you is to know what is the cash flows from operations, because those represent the real profits. Okay, and so some of the proxies for profitability include return on assets, return on equity, return on capital employed, and perhaps very importantly, return on invested capital. The perennial competition between profitability and market share, especially for young companies or startups. Their focus in their formative years is the growing of market share, and that is why you see a lot of these new age companies. They are going into tremendous losses, but at the same time they want to expand. They want to capture as many customer eyeballs or customer orders, and so profitability takes a backseat. So when these companies attain some level of maturity, they then start concentrating on attaining profitability. If prime example of that is Zomato. After going for years, after going at a loss, Zomato is now turning profits, much to the happiness of its investors as well as to its stockholders. Now, let us look at one by one the metrics that define profitability. First is return on assets. The classic definition of return on assets is net income divided by average assets. So, what does that mean? That means how much net income the company generates vis-a-vis the capital invested in assets. So, a higher ROA in most cases means that the company is efficient in extracting profits out of its assets, and hence it is more productive and it is more efficient. So how efficiently it is deploying its assets to generate profits. So that is key as for the definition of ROA. However, ROA for banking is an entirely different definition, an entirely different way of analyzing. So that we will come to when we look at banking companies. Here, it is more relevant for firms in the retail business. Another important metric is asset turnover. So the definition of asset turnover is sales divided by average total assets. Whereas in return on assets, we looked at ROA equal to net income divided by average total assets. So here, how do we define asset turnover is out of every rupee invested in its assets, how efficient is the company in generating revenue? Mind you, it's sales and not net income. Okay, so with the same assets, if the company is generating many times of sales, it is a good sign. Typically, you see, in retail companies like DMart or some of the discount retailers, you would see that the inventory or the items on the shelves are just flying off. So it is able to generate many times sales from the same amount of same assets. So a high asset turnover in most cases means that the company is able to turn over its assets more number of times. And typically, low margin businesses have very high asset turnover. Now, let us put net margin, asset turnover, and return on assets together and see what we can arrive at. So, net margin is net income divided by sales. And then we saw that asset turnover equal to sales divided by assets. So, if we multiply net margin and net asset and the asset turnover, what we get is return on assets. So, return on assets relationship can be with net margin multiplied by asset turnover. So it's a very interesting relationship. And then we look at return on equity, which means that what is the profit per rupee of shareholder capital. Return on equity is net income divided by shareholders' equity. Now we define another metric, which is financial leverage. Financial leverage indicates the level of debt that a company carries relative to its equity. So financial leverage equal to assets divided by shareholders' equity. And then combining ROE, ROA, and financial leverage, we get ROE equal to ROA times financial leverage. So ROE basically means that the company uses shareholders' equity with what efficiency. So how much return it delivers on the shareholders' money. So that means that if the ROA is around 10%, it means that the company generated 1 rupee of profits for every 10 rupee of shareholders' equity. Now, putting everything together, we see that ROE equal to net income divided by shareholders' equity. Then we see if we arrange these little creatively, we have assets on both numerator and denominator. This becomes net income divided by assets and assets by equity. So we have already defined these. And then if we put sales on numerator and denominator, what we get is ROE equal to net income divided by sales, sales divided by assets, and assets divided by equity. Now, we have already seen that net income divided by sales is net margin, assets divided by sales is asset turnover, and financial leverage is assets divided by equity. So a nice relationship between return on equity, net margin, and asset turnover and financial leverage. So what it means is that there are three factors which can affect ROE: net margin, asset turnover, and financial leverage. So a company which cannot charge a high premium, that means a company with low net margin, it is imperative that it has a high asset turnover. That means that it must ensure that it has a very tight inventory management, that is turn over more sales with the same amount of assets, which in effect boosts ROA. On the other hand, a luxury retailer like Titan can afford to have more capital tied up in their assets. So why is that? That means that they can have very luxurious ambience in their stores, well lighted stores. You have salespeople who are attending to you, giving you personalized service, etc. So a lot of money can be invested in assets. Why? Because they have a very high margin on their products. So they can tie up their assets more and more because they can charge a high margin. So now we come to perhaps a very important aspect, or rather very important metric, which is used widely in analyzing companies, which is the return on invested capital, or ROIC. So what is ROIC? ROIC is it's actually a better metric because it measures return on all capital invested, that is including equity as well as debt. Whereas ROE is just equity. Okay, so it gives you a more comprehensive or a more realistic picture of the return. So return on invested capital, the typical classic definition is NOPAT divided by invested capital. What is NOPAT? NOPAT is net operating profit after subtracting income taxes, but before interest payment. Or it can also be written as EBIT times 1 minus tax rate. And this is if there are no one-time expenses. Okay, and invested capital is equity plus interest-bearing debt. Okay, so what does ROIC indicate? It indicates how efficiently a company uses its capital to generate profits. ROIC typically, firms in the same industry can have similar ROICs, but ROICs differ substantially across sectors or industries. So in the numerator, NOPAT represents core operating income. Denominator, it represents the total capital invested in the business. So as I said earlier, high ROE means company is quite efficient in generating profits from capital invested. So different companies have different capital requirements. So for example, a company in IT sector will have relatively low capital requirements if compared to one in manufacturing sector. So comparing ROICs between the two sectors will not be meaningful. Rather, we need to compare companies within the same industry to get correct relative efficiencies and profitable metrics. So, for example, ROIC is useful in finding companies that have competitive advantage, or for example, strong barriers to entry, so that they have pricing power and strong management and their ability for value creation by investing capital in those projects which create high value. So, and see, there may be different interpretations of both the numerator and denominator as to what to include and what to exclude from the accounting statements. However, we are not pursuing an accounting endeavor. Rather, we spend a lot of so rather than spending a lot of time on individual items, one should rather be consistent in what we include or what we exclude, and use the same interpretation across our analysis so that we can do a apples to apples comparison. For example, many people include lease liabilities. They deal with cash separately or with rent, etc. So too deep into these actually create confusion. And in many cases, if you look at company reports, company financial reports, they themselves define as to, they themselves state as to, how they define ROIC. So what items they include, what items they exclude, etc. So we can take those same definitions but make sure that we are consistent in our definition across companies. Only then we will have a meaningful analysis. So one way to analyze the company is to compare its historic ROIC trend. So if we see an increasing ROIC trend over past history, then we know that the company is on the right path, and so it's on the right path for profitability. And then we can also compare the company with its peers in the same industry. Then we know how it is faring relative to its peers. But one should check that they follow the same definition for ROIC. Okay, so that's all for profitability metrics that are used in analyzing companies. We will now look at financial health. So how a company is managing its financial health. So that is also a very key metric in analyzing companies. Okay. So now a company may take external debt to fund its growth or operations. Maybe it needs to expand, or maybe it needs to put in substantial capex, which for which it cannot or does not want to dip into internal accruals. So it feels that it is better off taking external debt. And so, but however, one should note that taking on external debt increases costs because of interest payments. And then a large amount of debt causes earnings volatility. Why is that? Because when uh, when uh, when good business cycles, earnings go up, and during tough or bad business cycles, earnings undergo a lot of pressure. So as a result, there is a lot of volatility in earnings. And if you have debt now, because you have to pay interest, so there is no compromise on that. So it puts further pressure on earnings. And so that's what it says. When business is good, company is able to cover interest payments, and the rest of the cash goes to the bottom line. So whereas during down business cycle, the interest costs put pressure on earnings. So debt to equity ratio is one metric that is very important, and many money managers use this in their models that analyze companies. So debt to equity is defined as long-term debt divided by shareholders' equity. So let us look at another important metric in financial health, which is times interest earned, which is an indication of how diligent or how capable the company is to pay off its interest for the loans that is it has taken. So times interest earned is also called interest coverage, which is defined as EBIT divided by interest expense. So what that means is that how many times a company can pay off its debt if its entire EBIT is used for this purpose. Now, high TIE means that the company has less probability of default on loans on the one hand, but also a very high TIE also means that the company is not able to invest its earnings into value producing opportunities. So this is also a sort of a downside to having high interest coverage. And then we know financial leverage, which is assets divided by shareholders' equity, and a low financial leverage is preferable. So that's about financial health. Now we'll talk about risks. Now this is one aspect that not many money managers look at and incorporate into their models at the time of company analysis. So what are those risks that a company can face? One is if it's situated in a very highly regulated business or rather highly regulated industry, for example, gambling, casino, and things like that. And why? Because they are at the mercy of the government. Suddenly, they may come out with a policy. For example, there was this big controversy about Tamil Nadu. If there are any adverse government policies. So that is one, and the other is if the company manufactures so-called harmful products like cigarettes, tobacco, or like chewing tobacco like pan parag, etc. Because company suddenly the government if it wants to raise the revenue, it may suddenly increase taxes on cigarettes and tobacco and whatnot, and so that is why you see traditional tobacco companies like ITC, etc., they diversify into non-tobacco businesses so that at least some of the risks are mitigated or diversified. And the company is, in a dying, so-called dying or sunset industry. So, for example, I don't know how many of you are familiar with the BlackBerry story or point-and-shoot cameras versus, cell phones, companies like Kodak, Polaroid, etc. you know Constantly they have to reinvent themselves, and the company is not actively forecasting, or if it's not able to see what is in the future, and if it's not quick to respond to trends, then the risks to the company are very high, and it may go out of business because it is not able to quickly sort of proactively change its business strategy. And so that is another risk. It depends on the company, how quickly it responds to um, market trends and market situations. And then there is another kind of risk called the key man risk. What is key man risk? So, for example, typically we see a lot of these young companies where depends only on one person, which is the founder or the CEO, who sets the vision, who is in charge of operations, who is basically doing everything. And so when investors come in, they look at this particular risk. It's a huge risk. So if something happens to this person, then the entire company goes to dogs. So that is called the key man risk, and so people don't want to invest, and so it's a huge risk. And then the absence of a bench. So what happens if the competitor rates the significant part of the senior management? And so what happens, if there is not a strong bench, then, trying to sort of bring the new set of people and train those people, etc., is a huge responsibility. And so you lose valuable time, and then you lose valuable competitive advantage. And so that's the absence of a bench is a very important risk. And then if you have opaque business practices, uh, if your books are not transparent, if analysts and other interested investors are not able to understand, how you have done your books, then it's difficult to invest because everybody wants data and everybody wants the information to be very transparent and understandable. Only then people will invest. Okay, and so another risk is low promoter holding. So what happens if promoter holding goes less than 50%? That means that the company opens itself up for hostile takeovers and other kinds of issues, which are frankly a very big distraction. There are lots of cases where a corporate raider or a competitor has convinced other institutional investors to sell their shares to them and then launch a takeover bid. Very recently, you see the case of Precall, Premier Instruments, Coimbatore-based company, which was um, the target of a takeover attempt by Minda Corporation in Delhi. Ultimately, nothing happened, but their other institutional investors were convinced to sell their shares to Minda, and then Minda launched a takeover bid. So that's the kind of implications of low promoter holding. So these are some of the risks, not all of the risks, but these are some of the important risks that one has to incorporate or quantify when one needs to when one is analyzing companies. Then you have, last but not the least, the strength of management or corporate governance. And nowadays it is becoming very, very important. And the questions one must ask as an analyst is that, is the management fattening itself? What does that mean? Whether management is paying itself um, unreasonably more than the rest of the company. So do they have something like pay for performance, and how is the CEO pay relative to the average employee? What is that ratio? So these are certain corporate governance issues that serious investors look at, and whether management is paying itself or rewarding itself for with unusual perks like private jet, unlimited expense account, etc. And does the company have a very submissive board of directors? So what does that mean is a lot of these founder or promoter companies used to have friends and family as the board of within the board of directors, and so uh, uh, anything that the senior management or the founder of the company wanted, the board just gave a sort of a rubber stamp. So it was basically a rubber stamp board. But actually speaking, the board should be the conscience keeper of the company, and they typically should work for the shareholders. And so, a good board should have the spine to show the mirror to the senior management or CEO or the founder, and really, hold them to task as far as doing the right thing. And so, um, of course, things are improving now, but until recently, a lot of the boards just rubber stamped founder um, policies and founder decisions. So that is something that, as an analyst, one must look at and one must try to decipher as to what is the nature of the board. And then is there an arm's length dealing in awarding contracts to vendors? So is the vendor process transparent? And are there any kickbacks, or are contracts awarded to friends and family on a consistent basis? So it's basically taking money out of the left pocket and putting it back into the right pocket. So that is something that should not happen in a um, in a good corporate. And so, as an analyst, one must decipher that or uncover any dealings like that. And then, their books of accounts, is it very complex, or is it simplified and it's easy to understand? Because sunlight is the best sort of discoverer or truth. And so, if the accounts are um, um, transparent, then it's easy for analysts to understand the operations of the company. Or on the other hand, if it's opaque and the numbers don't add up, then do they also point to under or over invoicing? Then it's a big red flag. And so that is something that not only analysts um, look at unfavorably, but also the regulators look at it unfavorably. So one should stay away from such companies. And two of such companies, Satyam and DHFL, which is Diwan Housing Finance Limited, um, got caught when they were cooking their books. And you can take a look at the history of what happened with both these companies. So in summary, company analysis really is does not sort of mean that you look at one or two aspects of how the company is run, but there are quite a few metrics which can give you an indication of how the company is performing. Um, One of those is typical questions that one you must ask is, where is the growth coming from? Can it be sustained? And one should remember that the metrics or the ratios alone do not give you the entire picture. So, for example, a high ROE can also be manufactured, quote unquote, by taking on a lot of debt. So that is something that you should be quite aware of. Another thing is, earnings can grow, you know, from earnings growth can be achieved from many places. One is, uh, if the company is solely relying on inorganic growth. So, for the short term, it can grow earnings, but for the long term, it is quite a challenge. And so, one thing that you must sort of keep in mind is it an acquisitive firm, or whether earnings are inorganic in nature. And another big red flag is, do the earnings outstrip sales growth consistently? So if your earnings growth is substantially more than sales growth on a consistent basis, there is one should relook and look at that company very carefully, because it's a big red flag. And because only if you grow your top line, you can grow your bottom line. 1 or 2 quarters, or maximum 1 or 2 years, you can do some cost cutting, or you can take advantage of tax uh, efficiencies, or you can sell some divisions, etc. But they are not going to help you on a long term basis. So that is something that, as an analyst, you should be quite careful. And free cash flow, is free cash flow positive on a sustained basis, or you see free cash flow reducing? Negative free cash flow means that a company has to take on debt in order to survive. And then how leveraged that the company is, because high leverage on a sustained basis over years is quite risky. And so these are some of the metrics, in summary, that you can look at. But one thing you must be aware, that um, no one metric by itself is sufficient to do a complete company analysis. So one must use all of these metrics, and one must put them together and see if they are all telling you the same story. Only then you will come to a decision whether the company is an investable view. It's you want to put money into the company, or you don't want to put money into the company. So that's all for company analysis. And in the next session, we will look at valuation.